Good morning, my name is Robin Johnson. I'm Head of Investments at Nedgroup Investments. I'm here at the International Investment Summit here in London, and we've managed to grab 5 minutes time with Steve Romick, the fund manager of our Nedgroup Investments Global Flexible Fund. Good morning, Steve.
Good morning, Rob.
Thanks for joining us today. The first thing I'd like to touch on is your asset allocation process, or the weight of cash in your fund that sometimes people ask us about. Would you mind commenting on that as a residual of your process?
Sure. You actually stated in your last sentence, it is the residual of our process. If we find companies that don't meet our risk reward, investments that don't meet our risk reward, companies, or stocks or bonds, then cash ends up there by residual, by default. And so the great thing about that is, generally speaking, is that we are able to pull from that cash at a point in time where there is tremendous opportunity. So just in the likes of last week, we were able to pull from that cash when the markets were going through their disruption and actually initiate a couple new positions.
Yeah, that's you touched on another point there, that you're very much company analysts rather than equity analysts, and you have a big team of researchers within your firm focused on this strategy. Would you just talk about the team and what how they go about things?
Sure. There's 10 members of our team. There's 3 portfolio managers, myself, Brian Selmo, and Mark Landecker. And we have 7 investment analysts, 1 who plays a more journalistic qualitative function, and the remaining 6 are financial analysts. And we resource them to focus on those businesses that we believe we want to own at a price that aren't so distant from price. If something's going to have to drop 50% for us to wouldn't warrant us spending the time on it. So we look around the world for where there's bad news. We try and shop, if you would, think about a mall where the stores are on sale. We try and have our analysts go into the stores that have these shirts on sale.
Right. Right. And what about value at the moment? I mean, we've been in a long bull market now. Are you seeing any pockets of valuation around the world?
There's very, very few pockets. Around the world, there's been this global quasi-coordinated effort to keep rates low, and economies are actually doing relatively well around the world, from emerging markets to developed economies, although it's been a relatively weak rebound from the Great Recession of 2008 and 2009. So we're in a place where their economies are reasonably good, but rates remain very low, and people have been pushed into stocks by virtue of lack of alternative. And so valuations have been lifted as a result. So we don't see a lot of opportunity out there today. We do have one area of opportunity. We've been investing a small amount of capital, again, going to where there's bad news, and that's in the debt of Puerto Rico.
Oh, right, that's interesting. And how did you uncover that, and what's your expectation? Because I think there was some news yesterday from Puerto Rico about some additional problems there.
Well, there's been additional problems been announced. There's also been additional cash that's showing up, in Puerto Rico. So when we first started underwriting Puerto Rico, more cash is now appears to be in the books than even we originally thought. But every day we come into work, and the market poses us a question: is what's being offered a reasonable price to justify, the upside, the risk that's assumed for the upside that's there? And so we feel in the case of Puerto Rico that risk reward is attractive, although there's certainly no guarantees.
It reminds me of your recent quote where you say, we decide what we'd like to own and the market decides if it will give it to us at an attractive risk reward level. I think that's very good definition of the way you go about running money. Would you say that's fair to say? Absolutely.
I mean, the idea of the market offering us a certain price, and we get to come in every day and decide that that's the price that's attractive to us.
Right, fantastic. And fixed income, or interest rates, more importantly, 3 interest rate rises this year. How does that affect the markets as a whole, and do you see that as a negative or a positive for the next 12 to 18 months?
We don't really opine on what's going to happen over a 12 to 18 month period. In fact, we don't know what's going to happen in the future period. It goes back to the earlier conversation that we just had about we decide price. I mean, the market decides price, rather we decide whether we want to take price or not. So we don't know what's going to happen. We don't know what's going to happen to interest rates. I mean, at the same time, though, rates remain at relatively close to their all-time lows. And there's upward pressure on rates. There's inflationary pressures out there. And we do question, though, if the economy weakens again, or when it weakens again, what central banks are going to be able to do, because they're not operating from the higher level of rates to pull back from. So it could pose a problem in the next downturn. So we don't know. It is a long-winded way of saying.
Yeah. So that makes me think of an interesting question about, you say when there is a recession or the next time the economy falters, what's going to put pressure on the economy and businesses in general? Because do have high margins at the moment. We haven't seen wage inflation. When that comes through, is that going to put pressure on equities in general?
I mean, it could. I can't speak affirmatively, but certainly if you have wage inflation and you're not able to get price to offset that wage inflation, that will compress what you acknowledged are high margins. If that happens, that's going to put pressure on earnings and companies will disappoint.
And like yourself, I think companies have a lot of cash on the balance sheet. Do you think they'll put that to work anytime soon? Is that something that could help extend this bull market? There's companies that have cash. There's a bifurcation in the universe of companies. Some have a lot of cash, the Microsoft and Googles and Facebooks of the world. And there's a tremendous number of companies that don't have a lot of cash, that are actually quite highly leveraged. We are going into, whenever this next downturn occurs, we're going into this next downturn in the United States, certainly, with more debt on the books of the highly levered companies than we had in the last few recessions. So the debt to EBITDA in the market is higher than it's been in prior good economies. We usually see something like this, debt to EBITDA at these levels in the recession when EBITDA is weakened. Similarly, the interest coverage of interest expense, EBITDA coverage of interest expense, is relatively low for what is a relatively good economy. And those companies are definitely at risk, and there will certainly be some restructurings coming down the pike. Right, and with the heightened volatility brings opportunities. You must be excited for the year ahead.
Well, I'm always excited when there's volatility. That does create opportunity, to your point.
Thank you very much for joining us today, Steve.
Thank you for having me.
That was Steve Romick, Fund Manager of our Nedgroup Investments Global Flexible Fund.